Hey guys, what's up? Alec back with the daily stock market, and today we have a pretty crazy day in the market. It was looking good. All stocks were basically up a couple percentage points, and then all of a sudden they started going down, down, down. We even have a firm down around 20% in the span of 15 minutes. But today, what we're going to be talking about, we're going to be doing a deep dive on PayPal, one of the best stocks, in my opinion, to be loading up for long term. And we're also going to do a deep dive on Block or Square. And we're going to compare them against each other and see which one is the better one overall. So first up, we have Block at $108 per share currently. It's been bouncing off a bottom support here of around $100 and $102 per share. So if it goes that low again, I would even consider doing a short-term call option. If we scroll down at a glance, we can see the PE ratio is 107, applying that it is overvalued. The market cap is $63 billion, and it's very close to a 52-week low. And on average, the volume is around 20 million. Now, if we head over to PayPal, we've seen it this low last week at around $118 per share. So that's a support we want to see it bounce back up from. We even see them as low as $120 per share in 2019, and the company has grown expansively since then. At a glance, we see the PE ratio is 34, which is a lot more attractive, implying that it's a lot better deal right off the bat with a market cap of $138 billion. And the average volume is a little bit lower than the current daily volume. We can also see that the 52-week high and the 52-week low is very similar to Square, with the same amount of upside to a 52-week high. So this is a summary on Square. After nearly a 60% drop in price, shares of Square are now cheap again. The valuation is kind of, we already saw it as a 100 PE ratio. The Cash App and block payment ecosystem will continue to grow. Shares of digital payment company Squares are on sale after the price dropped to nearly one-year lows this week. Correction in the fintech industry has gone too far, and leading financial service providers like Block and PayPal are set for major rebounds. Because shares have become so cheap, the risk profile for Block or Square is skewed to the upside. Cash App ecosystem is set to drive revenue and gross profits growth for Block. Fintech plays an important role in the cash-free economy. The process payments, oftentimes much faster than regular banks, create easy-to-use apps for transactions, and make online purchases more convenient than ever before. The development of Cash App, a mobile payment service that allows users to transfer money to one user to another, has driven Block to the top of the fintech food chain. Besides Cash App, Block offers payment services for merchants like payment processors, point-of-sale products. Block also offers savings on loan products and small companies. Now remember, PayPal does own Venmo, so we'll compare Venmo versus Cash App in a second, but some risk with Block. Block may face a slowdown in revenue and gross profit growth in future as more fintech bring new financial products to consumers and move in the small business segment of digital payment markets. The digital payment market is going to grow together with the broader e-commerce market, which could prompt new disruptive fintech with potentially better technology to step and try to undercut large financial services providers like Block. Slowing revenue and gross profit growth is possibly the biggest risk for Block. And this was an interesting article by the Motley Fool. Don't look now, Square's Cash App is almost as big as Venmo. Square's Cash App had 70 million transacting users last year. The service is growing through product innovation. It's still a big opportunity for further expansion in its user base. In Square's most recent product announcement for Cash App Pay, the fintech provider provided a small detail about Cash App's user base. Square sellers will also be to better reach Cash App's more than 70 million annual transacting active customers. It said in its press release. Square previously kept reporting on Cash App to monthly active users. Rival Venmo, owned by PayPal, users the metric of annual customers, and PayPal's latest Venmo update said it had more than 75 million active users. That means that Cash App is within striking distance of taking over Venmo. All right, and this was posted a couple months ago in September. So it would be interesting to look at some more updated numbers. Also, if you want to read this article in your own time, feel free to slow this or pause it. Feel free to pause it as I scroll down. But as you can see, Cash App, if they keep growing, they can easily take over Venmo. Right now, it's almost 50-50 market share. But if one starts gaining more leverage on the other one, that can be a big deciding factor in investing in Square stock or in PayPal stock. So don't be scared to adjust down the road a year or two from now if Venmo is taking over Square and Square's business model is failing and everyone's downloading Venmo. You might have to call an audible and dump Square and put it into Venmo or vice versa, because that is a huge part of their business model right now. Moving on to read a little bit about PayPal, you see a summary. PayPal has seen a hard reset. The 2022 guidance and strategy reset is underwhelming. I have a long-term consensus as well, but valuations have been reset in a couple ways, creating huge potentials. PayPal has completed its round trip with shares back to $118 at the moment of writing, at the same levels they were trading in pre-pandemic broke out in 2020. So what now? Investors seem to fear the competitive position of PayPal here, with 426 million consumers and tens of million merchants being active on their platform, as new additions fall below 10 million additions per quarter. All right, one reason might be the fact that the cost of service is quite high. The high cost might be a factor behind eBay's reduction involvement, as well as the merchant platform rapidly reduced reliance on PayPal. PayPal recently indicated that the shares of eBay revenues is down from 10% of the total revenues to just 3%, that in the time frame of just a year. On the other hand, I am very pleased to be able to buy shares at 23 times forward adjusted earnings here, while the valuation came in at a more than 50 times in recent sales. So PayPal is seeming more like a fundamental play. You know, the numbers are better, the valuation's better. It's more of a value play, where Square is more of a growth risky play. All right. And PayPal still has huge growth behind it, as you'll see in a second. We'll go over here. It seems that competition and too high fees are starting to hurt the business, as PayPal is resorting to a dramatic change, including a revamp of the strategy, no longer focusing on near-term user growth, but more on the competitive offering in the long haul. So that's a great thing, is that they are looking at the long haul instead of the short term. This latter includes a super app, more exposure to crypto, etc. That same focus on crypto based on blockchain technologies are not high fees, in what causes the overhang on the true long-term potential of the business, albeit that PayPal's profit margins are not exorbitant. All right, and that's what Square is trying to focus on, is blockchain technologies, but here they're saying that the fees aren't too high, so that could cause an overhang. All right. Hence, investors which are underweight or equal weight to the technology sector should probably buy some left and right, as this likely includes PayPal as well. Yet, I fail to have conviction here on the shares, given the certainty of the long-term business model. All right, 2021 earnings and 2022 guidance. I would start comparing revenue goals with guidance, primarily to access the company's growth. PayPal's goal is to reach $50 billion in revenue by 2025. The management expected to have compound growth rate of 20% year over year to achieve that. So here we can see we're going to have amazing growth. PayPal's expected around 20% growth year over year. So the stock price should hit 10 to 15% growth following the revenue. Now, we also want to see Venmo continuing to grow, and the other things that we're talking about, net income also continuing to grow as well. That seems like a very ambitious target, they're saying, considering the company in the last 10 years has only reached and exceeded 20% growth in 2017 and one time in 2020, which we'll look at in a second. However, we must remember that there are changes in the multiples through the life of the company. For example, PayPal was priced as a high growth company in 17, 18, and 19, even more so in 20 and 21. But now PayPal's numbers are regarding expectations for 2022 may make some investors doubt the possible growth over the next few years. Do you think the target given at the beginning of 2020, with an aggregate annual growth of 20% year over year, the next 5 years as possible figure, despite the guidance already for 2022, point to the slowdown in revenue growth, increase in the numbers of users, and a decline in margins? If so, the company at these prices is an apparent bargain. So let's dive a little bit deeper into the numbers. We have pulled up, this is PayPal, by the way, their income statement, their net income in 17, you can see it was 1.9 billion, and they grew 40% from 16 the year before that. In 18, you see they only grew 5%, not much. In 19, they grew 18%. In 2020, they grew 70% to 4.2 billion. Now, if we hop over to total revenues, here we can see it's been increasing steadily for the last 5 years. So typically it's actually really hard to look at total revenues and see like a 20 to 15% increase year over year. That's what we call a revenue monster. So if you ever hear me talking about a revenue monster, someone that increases revenues double digits consistently for the last 5 years. So PayPal, check. It's a revenue monster, and that's why a lot of people like PayPal, why it's been listed as a growth stock in the past. However, it's getting more to a valuation stock with the numbers of the PE, the forward PE, the price to sales, which we'll look at in a second here too. Now, if we look at the balance sheet, here we see it's 75 billion in assets and 54 billion in total liabilities, which is a little bit concerning. It's not too bad because they have 5.2 billion in cash and cash equivalents, which is a ton. However, they do have a lot of debts as well. But if we look at the updated numbers, let's see, total assets, updated numbers is 75 billion, which is the same as it is now. And then total liabilities is 54. All right, so those are updated numbers for 2021. And overall, I'm going to give them an A plus on total revenue. I'm going to give them an A on net income, maybe like an A minus. And I'm going to give them like a C. I'll give them a C minus for their balance sheet. Let's take a look at Square. Before we take a look at Square, here's some other numbers to look at. PayPal, you see the free float market cap, 138 billion. Price to sales, 5.5. Price to book, PB ratio, 6.4. All right, and then you can also see some other stuff like the EPS, the forward PE. The forward PE is only 25, which is fantastic. So as you can see, Square is a lot more of a growth company with the PB ratio 16, PS ratio 5.5. Forward PE is 65, which is not as bad as its current PE, which implies that it's actually going to be a better deal if you buy now for the future, because the forward PE is only 65, which typically it's actually more important to look at the forward PE. But let's hop into Square's net income. All right, so look at that. They're not even a profitable company for 16, 17, 18. They hit their first profits in 19, and then they lost their profits, about 43% loss from 19 to 20, so which was 213 million. Now, if we look at their net income, it was actually negative last quarter, and it was positive 200 million the quarter before that, and it was 39. So they had one good quarter, which was Q2 2021. All right, Q3 was horrible. They were negative, so they might even be reporting negative EPS. So remember, I gave PayPal's net income an A. Square's net income gets a C minus or a D. All right, so they're going to have to do something to fix that ASAP. However, you see where the true value is in Square. Look at that revenue monster. You guys thought that PayPal was a revenue monster? Look at Square. So that's why these valuations are justified, and that's why typically you see like Tesla stock, for example, with very high PE ratios, and people are still buying them, and analysts are still saying they're a good buy, is because the revenue growth is off the chart, and net income isn't as important for a company that's growing revenues by 30%, 40%, 100% from 19 to 2020. That was 100% growth, and they pretty much haven't had under 30% growth in the last 5 years, which is spectacular. That's an A+++ on the revenue growth. So that's the main thing you're buying into Square. When you're buying into Square, is you're buying in a growth company, and it's growth investing. So there is a lot more risks involved when you're investing in a growth stock like this, but there's also typically a lot more reward. Now, the good thing is when you see a growth company like huge growth monster like this, 30% or more, 100% revenue growth. Typically, their balance sheet shot, and it's not good at all. And their assets are very low. Their liabilities are very high. They're very high in debt. Square is not like that. All right. Now they have a 72% liabilities to assets, which isn't the best thing in the world. So we would want to see those liabilities a little bit lower. They only have 7 billion in liabilities and they have 4.5 billion in cash and cash equivalents. So I would honestly give them a better rating on their balance sheet than I gave PayPal, just because their cash and cash equivalents compared to their liabilities, their total liabilities, is a better ratio than PayPal's, which means that if anything hits the fan, if stuff hits the fan and they're going under, they have to pay their debts for whatever reason, they can pay them. They have a lot of cash on the balance sheet. So I would probably give their balance sheet probably like a B, honestly, like a B minus. They could improve a little bit, get those liabilities a little bit down, but they would need to become profitable first. And Square can definitely be a company that's going to be here for the next 5 or 10 years. All right, especially with Jack Dorsey at the head of Square. If you guys didn't know, he stepped down from Twitter to be the head at Square. And when blockchain, and if they are a leader in blockchain transactions, that could be huge, huge things. Overall with Square, I think they have a lot more upside potential with a lot more risk involved. PayPal, on the other hand, has a lot more stabilized. They're a more established company with a lot more to lose than Square. If Square gets the market dominance over blockchain and the market dominance over Cash App and Venmo, that can be bad news for PayPal. So with that being said, I think they're great. They have great spots in both portfolios. PayPal, for example, I'm sticking in my long-term portfolios. With Square, I'm sticking in my long-term portfolios as well. But with PayPal, I'm sticking them in my more conservative portfolios. And with Square, I'm putting them in my more high-risk kind of growth portfolios that are all long-term. These are both long-term investments, in my opinion, by the way. So if you want more risk and reward, go with Square. I'm personally going 60% PayPal, 40% Square, just because I think PayPal is a safer bet overall with less upside. And remember, Square is about half the size of PayPal, so they do have a lot of room to grow. But let's look at what the analysts have to say about these two companies. So Square is the first one. The analysts have 100% upside in the next 12 months, and that's on average. They have $229 per share. Personally, I think they can be at $300 per share in the next 12 to 24 months, which would be a fantastic growth, over 100% gains in the next 12 to 24 months, which is anyone can hope for and pray for. Now you see some 5-star analysts coming in from JP Morgan at a $200 buy point. The last 9 days they reiterated that. Here you can see some other 5-star analysts all above $200 per share for Square in the next 12 months. Hopping over to PayPal, they only have a 56% upside in the next 12 months, with a price target of about $186 in the next 12 months. I disagree with that. I think they'll be closer to $200 to $250 in the next 12 months, and I'll probably give them around a 75% upside in the next 6 to 12 months. I think both PayPal and Square can bounce back in big ways, but remember, these are mainly long-term stocks that you want to invest in for your long-term portfolio. Here we see some analysts from Bank of America, Barclays, and you'll actually see 5-star analysts reiterated 8 days ago at above $175 and $200 per share in the next 12 months for PayPal. So I hope you guys enjoyed this video. I know you guys have been wanting me to do a PayPal video for a while now, so I got that done for you. If your friend or family member is a PayPal or Square investor, share this video with them so you can drop some knowledge and get them educated for their future and which one to invest in and the pros and cons of each and where they kind of fit in each portfolio. I hope you guys did like that video. If you guys want to join my close friends list, I have a couple more spots left. That's where I post all my buys, my sells, when I'm buying, how much I'm buying, and a lot more tricks and tips every day. Something new you can learn every single day in the close friends list. Every day the market is open. So comment below. All I ask, guys, is like this video, and I'll keep making these videos for you guys. And subscribe with post notifications on, ring that bell. I'll see you in the next video. Remember, don't time the market, buy the market. Peace.